Good morning, everyone, and welcome to week 10, depreciation, amortization, and break-even analysis. I'm coming to you from my basement office slash gym, and I'm trying out a new headset as well as a new video camera, so I hope it works well. So this is the new start to a new set of 3 weeks of different activities that we'll be doing. This week will be a little bit different where there will be no in-class activity or there'll be in-class examples that you can work off, and as well as there's going to be no live class for this particular week. The reason for that is because as much as I like seeing you, and I will be available to answer any questions, this stuff is fairly straightforward, as well as at this point in the game, you should be able to self-direct learn through the material that's given to you. So as far as the agenda for this particular lecture, we're going to be talking about depreciation, 3 different types, so straight line, decreasing balance, and units of output. So basically we're just talking about how these assets lose their value over time, and then we'll also be talking about break-even analysis. So like we said before, depreciation is the loss of value over time. And thus far, in most of your accounting classes and everything else, we've always talked about straight line depreciation, or the straight line method. From your accounting classes, you also know that there's a few things or a few pieces of information that you need to know. So the book value of the original purchase price of whatever asset that you have, the estimated useful life. How long do you think that vehicle, that TV, that computer is going to last you? As well as when it comes to the end of its life cycle, is there any value still? So even a vehicle that's probably not even roadworthy might still be worth $1,000 for scrap or materials. So those are things that we'll be looking at, and how do we work in 3 different types of depreciation methods. So depreciation does provide a method of allocating the cost of an asset over time. So it's essentially trying to match up the use of it over its lifetime. So we require 2 different accounts. We've already seen the depreciation expense account. So that's the amount of a depreciation declared in a year. And then the accumulated depreciation, which is the total dollar value of the depreciation declared against the asset from the time it was purchased. So basically it's the amount that we have reduced from the original asset value. Thrilling stuff, I get it. It is a contra account. So a contra account, if you remember this term from accounting, basically means contrary or opposite, and it's linked to the original account. It records decreases in the value that the account, so the original value of the related account remains unchanged. As an example, the cost of an automobile is $30,000. We know that the net value of it today, after being used for so long, is $16,000. So we have to have this accumulated depreciation asset account of $14,000. So it's just basically saying, okay, I know I bought it for 30. I know it's not worth 30 anymore. So I just need to have all of my accounts in place so that there's a record of how it originally was, what kind of use it endured or went through, and now what is the remaining value of that asset. So that comes to what we're going to be doing. So we look at 3 different methods, although there are many different methods, and depending on what kind of asset you're looking at, these will change. And a very good example is real estate. So real estate really doesn't have a depreciation. They appreciate, so they go up in value over time. Although many pieces of the house inside the house will depreciate. So it's very complex. So we're looking more so at equipment that we'll be using in a business. We'll look at straight line depreciation, of course. It's the easiest to explain, and it's the easiest to do. We look at reduced balance depreciation, which is it decreases at a constant rate as the life of an asset progresses, and then the units of output, so based on how many hours or kilometers that we use on that particular asset, that's the amount it'll go down in value. Okay. So this illustration is based on some of the following information, and it kind of looks at all the different ways that we could potentially reduce our asset using depreciation. So let's just say that we have a cost of a fixed asset of $100,000. We know that at the end of the life of the asset, it won't be worth anything. And we think that we'll use this up in 4 years. It also tells us we expect to get total machine hours of 20,000, and the rate of depreciation is 40,000. So these are all different. We might not use all of this information for one particular type of depreciation, but we'd use all of this information amongst different ones. So basically right here, this would show you how some of these different things would depreciate. Whereas in some of year's digits would depreciate a lot in the first year and less over time. And reducing balance has a bit of an arc motion. Units of activity may depend on the years in which that you actually use it. So you might not use it a lot in the first year, but more in the second year. And then straight line, of course. So when it comes to straight line, the advantages are it's very easy to calculate. It's useful where the pattern of economic benefits are hard to determine with precision, and it's suitable for depreciating assets that provide similar level of economic benefits. So it's the most common. When it takes more time to figure out a schedule of depreciation, a lot of people just say, okay, we're going to straight line it because we know at the end of the term it'll be about the same. And we can budget on that. We can plan on 20,000 a year depreciation versus 50,000 the first year, and then 30,000, and then 5,000. That changes too much. So what we're going to do is just a straight line depreciation. Some of the disadvantages, it may not reflect the true pattern of the asset's economic benefits, which means it may not reflect the actual depreciation amount. But just like when we do inventory cost controls or inventory costing, sometimes that latest purchase price is not 100% accurate, but it is by far the easiest to do. So this is an example. So it's a tour bus. It costs $12,000 with a $2,000 salvage value and a useful life of 5 years. So this is the straight line method of annual depreciation. So every year we want to find out how much to go down. We take our cost and we subtract the salvage value. So we know that although it costs us $12,000, $2,000 is what we expect to get out of it at the end of this. So therefore, it's around $10,000 of value that it will go down over an estimated useful life of 5 years. So 12,000 minus 2 is 10. Divided by 5 years, it's about $2,000 per year, or 20%. So that's very simple. Straight line depreciation, $2,000 a year, and every year it'll go down that much. The reducing balance, it's appropriate where the usefulness of an asset declines over its useful life. So a very good example might be a computer or a television, where for sure it will go down, but the amount of hours that you put into it also affects it. So the reducing balance depreciation takes off a larger amount of the asset's cost near the start of its useful life. And this is particularly relevant with purchasing a new vehicle. That's to say, when you drive it off the lot, you lose 30 or 20 or 40% of the value. So the cost of the tour bus, as an example, would be $12,000, and we'll depreciate it by 30%. So the first year, 12,000 times 30%, it will depreciate by 3,600. Then the book value at the end of year one is 12,000 minus the 3,600 that we depreciated is 8,400. Year two, 8,400 times that 30% depreciation rate, it's 2,520. And the book value at the end of year two is 5,880. And then if you wanted to do year three, it'd be 5,880 times 30%, and that's the depreciation rate. So it sets that percentage. The percentage doesn't change, but the values of the amount of depreciation change over that time. And then units of activity. So other than straight line, I think this is the next most common one. It most accurately reflects the pattern of consumption. It's suitable in cases of fixed assets that depreciate in proportion to the amount of activity that they see. So when you think about televisions, yeah, when you think, hey, we should get 5,000 or 10,000 hours out of a television, sure, but if you were in a hotel lobby television that is literally on 24/7, you might not get that 10,000 hours out of it. Just because it's on all the time, it could burn into the screen. It's not supposed to be on all the time. It won't last that long. So there'll be different things that we have to keep in mind. So the example for this is that same tour bus. So it's more so, instead of the amount of years that we think we'll have, it's going to be the amount of kilometers that we can expect to drive. So we're going to say, okay, we expect that this tour bus is going to travel 200,000 kilometers in its lifetime. So we're going to take our cost minus our salvage value. That remains the same. And then we're going to divide that by the estimated entire life output. Okay, so that's 200,000. And then once we know that, then we'll multiply it by the annual units of output. So first we're going to take 12,000 minus 2,000, which is 10, divided by that 200,000 kilometers, and it'll give us about 5 cents for every kilometer in depreciation. So every kilometer we drive, our tour bus is now worth 5 cents less. Now, we know if a bus travels 14,000 kilometers in a year, it would be that 5 cents times that 14,000 kilometers, therefore about $700 in depreciation. So 14,000 kilometers on a $200,000 vehicle, it's really not that much. It has a lot of life left, but it's interesting to note it only went down $700 in depreciation. And if we look back to our straight line, it would be going down $2,000 per year, because we don't even know how many kilometers that we drove in this particular scenario. So yes, straight lines easy, but units of output or units of activity is by far the most accurate. And it's easy to see how many kilometers that you would drive on a vehicle. Maybe not as easy to record how many hours on a TV, but they might have an internal monitor of that. A couple things about depreciation and income taxes. Essentially, and we've spoken about this a little bit, depreciation expenses reduce income. Therefore, it saves on income taxes. So let's say if I made $5,000 last year, but I depreciated one of my assets by $2,000, like we just had an example, I would only have $3,000 in net income. So I'm only paying income tax on that $3,000. So it reduces our net income. The recovery of depreciation expense is after the item is sold. So basically what happens is that once I sell that item, let's say we thought we'd get $2,000 at the end of a salvage value. Somebody gave us $2,500. We'll add that as income at the end. We'll say, hey, we thought it was worth $2,000. That's what we had it on the books for anyways, on our balance sheet as $2,000 of worth. But we sold it for $2,500, so that would be a $500 increase in income. And then same thing, if we sell it for less than book value, it would actually reduce our income. Let's say we sold it for $1,500 and we had it on there for $2,000. We would lose $500 in income. Just a quick thing, what is amortization? You probably heard this term before. We talk about it a little bit. Essentially what you need to know with amortization, it's a payment schedule. So a lot of people here, a lot of people who have mortgages for their homes, their amortization is 25 years, but their mortgage is 5 years. So, they have a 25-year mortgage in which they have a 5-year term. So they say, okay, you're going to pay us 3% interest on this 5-year term, and at the 5-year term, you can remortgage. The amortization is just the length of time that you have to pay off that asset. Same with your vehicles. If you do a car payment plan where you walk in and it's like a 7-year payment plan, that's an amortized over 7 years. And that's essentially what that means. Which brings us to break-even analysis. So the next little part is what we're going to go through is trying to determine, and this is not the easiest thing in the world, but trying to determine how much do I need to sell in which to break even, to make $0. And then everything after that would be start bringing in income. So we're looking for the break-even point. Revenue equals fixed cost plus variable cost is what we're looking for. So when these equal, then we know that we are at break-even. So the break-even technique. So as an example, our fixed costs are $1,650. Our variable costs are $350 per unit, and our selling price is $500 per unit. So as an example, let's say I'm selling tables. So it's a table that I sell for $500. but it cost me about $350 in which to bring it in. And I know my fixed costs for the month it's $1,650. It's my staff, it's my labor, it could be my lights, my utilities. I'm not really certain, but that's what my fixed cost is, assuming I sell only this one item. So my break-even point would be I have revenue, $500. So we go back here real quick. Revenue equals fixed costs plus variable costs. So the revenue, 500, equals 1650 plus 350 per unit. So therefore our revenue is only $150 per unit equals 1650, the fixed costs. So we need to sell 11 items in which to break even to make 1650. If we sell 12 items, then we make $150 per unit. And if we sell 13 items, we make $300 now. And so on. $150 keeps on going up and up and up. And this is how you can see how we can break even, but as well, how we can set an amount of revenue that we want to earn. So let's say, hey, I want to make $2,000 by the end of the month. I can take that $2,000 divided by that $150 per unit I'm making, and I'll know exactly how much I need to sell over and above my break-even amount. There's also an alternative technique. So this is the break-even point. So BEP stands. BEPU is a break-even point units. So how many units need to be sold to break even, and the BEP dollar sign just shows the break-even and point sales. So this is a little bit, sales is probably more widely used just because we sell multiple things and they're not always the same price. Whereas in units, they need to be a pretty static price on this, not changing. And you need to know exactly how much you make off each particular unit. And variable costs change and prices change, so the sales is probably the easiest. So like we said, what we did previous was the BEPU, break even point for units, the price, fixed cost, over price minus variable costs. So it's a different way of looking at it. I actually think I like this a little bit better. So the fixed cost is $1,650 over the price 500 minus the variable cost 350. So it's 1650 divided by 150 equals 11. Just what we just did before, although we used this break-even formula before. BEP dollar sign is how many units times the selling price. So 11 times 500 equals 5,500, which means we need to sell $5,500 worth of our tables in which to break even. That's what that is. And it's the same thing here. So it's just 11 units times 500. Operating leverage. So once break-even point is achieved, each additional unit sold will produce a relatively large percentage increase in profit. You've already paid for all your fixed costs. Everything has been paid for. Now at this point, it's just all income. So in the above example, the 12th unit sold will produce a profit of $150, and this profit represents the contribution margin of each unit sold. Companies often invest in expensive equipment in order to lower their variable costs, such as labor. So the variable cost is fluctuating, right? So fixed, we know exactly how much. Variable cost, we don't know exactly what the labor is going to be, what the cost of wood might be. If let's say we're building and assembling these tables ourselves, what kind of time it takes in which to create these. So fixed costs increase with the purchase of more capital equipment, but the goal is that we want to decrease our variable costs. So we can move up our fixed cost to $2,000 a year. We have to pay a little bit more every single month in order to have this new piece of equipment, but it creates tables in half the amount of time. And we only have $75, we only pay $300 or $250 variable costs, and then we make more per unit. So you can see how this fluctuates a little bit. Our fixed costs are set, our variable costs can change. We can invest money, and it'll be an investing activity in a cash flow statement. We can invest money into our fixed costs in order to lower our variable. This is just a nice little chart that kind of shows you the break-even point. So there's at a certain magical little spot where we break even, and that's perfect. So it could be 400 cost in dollars and the volume. So we have to sell 450 or so units at a cost of around $450, and that would break even. And it'll show you as we sell more units, we start making more money, and as we sell less units, we start losing some money. And this is that variable cost amount. Basically, we want to see this profit corridor. We want to be within this where we are starting to make money. So a little bit more difficult is that we often just don't sell a single type of table. Rather, what we do is that we sell multiple different pieces of equipment or multiple different food and beverage or multiple different styles of hotels or rooms. So therefore, we have to think, okay, so we sell more than one product, therefore we have a lot of different break-even equations. We need to set these up in terms of percentages. It'll be a little bit easier for us to estimate what our break-even would be. By the way, it's 8 a.m. on a Sunday morning. I'm doing this early to ensure that my dogs don't have a connection and that my wife's still asleep. Okay. So the percentage relationship. So in this scenario, we're assuming that we have fixed costs of $30,000 a month and that our variable cost is 70% of our selling price. So it's not a dollar amount like 350. We're just saying our percentage amount is 70%. So we pay about 70% of our selling price as our variable cost. So at the point of break even, revenue equals variable cost plus or fixed cost plus variable costs. So our revenue equals $30,000 plus 0.7. So 0.3, so 70%. 0.3 equals $30,000. Now, if I take 30,000 divided by 0.3, I will find out that our revenue must be $100,000 for us to hit our break even. Now, there's probably a better way of looking at this. This can be confusing for some people. So basically saying if I sold $100,000, 70% of this would be $70,000, and that's my variable, that's my variable cost. And then $100,000, 30% of that, which is shown right here, would be my $30,000, which is my fixed cost. This becomes much easier when you see it on paper. If I only sold $50,000 of revenue, 30% of that would be $15,000. So I'd only meet half of my fixed cost. So that's not going to work. So here's another multi-product example. So this is our fixed cost. Let me move me right up here. This is our fixed cost is $3,000 per month. So we sell a sandwich, a drink, and a baked potato. We're like a little food and beverage spot. Like a little chip wagon. So this is just a very basic example. These are the price of all of our items, and these are the cost and our annual forecasted sales units of each of these. So the price, the cost, and how many we expect to sell. From here, we want to do a little bit more math. So we want to extrapolate or expand, as they say. So let's go take a look. So if we want to determine our total revenue, we would take our price amount and we just multiply it by our annual forecasted sales units. Now this is going to be all this stuff here. If you're wondering where this information has probably gotten from, this would be from historical data. So assuming you've been open for more than just this particular month, you can look back at previous months, previous years, and get an idea. If this is your first month, this would be a big old guessing game as far as trying to really determine how many you think that you're going to sell. So let's do our total revenue. So we've taken our 3 different items and the revenue amounts for each, and we've just extrapolated. So we expanded by multiplying by 9,000 units for both sandwiches and drinks and 7,000 for the potatoes. And we've determined that we would make about 72,500. Our total variable cost, so we know it's $3 for sandwiches, 50 cents for drinks, and $1 for the potato, and we have determined that is about $38,500. So our gross margin, 72,500, this is a little typo, minus 38,500, the variable cost equals $34,000. So this is how much the gross we get from our sales. So the variable cost of $35,000 divided by 72.5 is 0.531, or easier to understand as 53.1%. Variable cost of 53.1% on all of our items that we sell there. So our gross margin percentage is 0.469 or 46.9. And you can just say it's 53 and 47. That's probably what you look at it. So this means based on the sales above, you would keep about 46.9% of your revenue. So fixed costs are $3,000 a month times 12 months. So we're looking at $36,000 annually. So our break-even revenue is revenue, as we said before, revenue equals total fixed costs plus variable cost times revenue. Variable cost being the 53.1% times revenue. So revenue equals 36,000, right? We just got that number right up here, plus 0.531R, which means the revenue times 0.531. Now revenue, so we're just going to move this over to the other side. Revenue minus 0.53R equals 36,000. Therefore, so when I do this, we're understanding that revenue is 1. So basically I'm saying 1 minus 0.53 equals 0.469. So what's the remaining left after our variable cost? So 0.469R equals 36,000. Again, we're going to move this back over across the equal sign and change it. 36,000 now divided by 0.469 equals 76,759.06 cents. So we need to sell $76,759.06 of sales in order to break even. Now, as I said before, in all of your activities and all of your tests, you will always have these formulas. There's a couple simple, well, I say simple, but there's a couple things that you need to understand as far as like moving one number across the equal sign. It often changes. So if it's a division over here, it changes to a multiplication. If it's an addition, it changes over to a subtraction. But basically what we're trying to do here is using this formula, which you can also use the alternative technique. I want you to be able to find break-even revenue. And we'll have some examples for you to play through and get going on that. So here's depreciation one that I want you to look at. So Mike's Hardware bought a new 70-inch television worth $4,500. He expects this TV to last him 5 years. The salesman at the store where he bought the television has told him the TV is expected to last 40,000 viewing hours, and within the first year they used around 11,000 of those hours. So, knowing what you know, determine the straight line and units of output method of depreciation for the first year. So I want you to determine the first year, knowing that the residual value is $750. So what we would do is something like this. Straight line method. So we take our annual depreciation, and it equals the cost minus the salvage value divided by the estimated useful life. So as we looked up here before, it cost you $4,500. It's going to last you 5 years. And our residual value, and so if you see residual, it's also going to be salvage value of $750, which means how much do I get at the end of it? So we do our math. We do 4,500 minus 750 is 3,750. We divide it by our 5 years, and we're thinking it's going to last us $750 per year. Now, because it's straight line method, we can actually go all the way for the 5 years because we know it's $750 a year. So it starts off at 4,500. There's no depreciation in year 0. It's worth 40. After the first year, we'll go down to 75. Accumulated depreciation is all of the depreciation to date. 750, and it's 3,750. And then each year we're going to keep removing $750 away from it. And then you'll see our accumulated depreciation will keep increasing by 750. Our book value will keep decreasing by 750 until we are remained with what our residual value will be at the end. And then at the end of year 5, either what you do is you try to sell this 5-year-old TV for $750. If you only get $200 for it, you're going to lose some income. If you get $1,000 for it, you're going to make a little bit of income. But there's always usually a residual value saying the asset's not worth nothing. There is some value, but it might not be easy to attain. I think of Kijiji and everyone trying to sell their stuff. They might want to get 750 out of it, but you can assume that you might get a little bit less. So when we talk about units of output method, so as an example, we think how many hours is this TV being used? We spent 4,500 on it. We think we're going to get 750 from it in 5 years. Okay, we know that. We also know that they almost guarantee that it should last you 40,000 hours. So using that, we will determine how much depreciates per hour of viewing. And then we'll multiply it by what Mike's hardware store used last year, which was $11,000 or 11,000 hours. Okay, so we're going to take the annual depreciation, which is 3,750, 4,500 minus 750, divided by 40,000 hours times 11,000. So we've determined that this amount here is actually 0.9375, so just over 9 cents of value is removed, times 11,000. So the annual depreciation is 1,031 based on watching it 11,000 hours a year. When I look to this, we are depreciating it by 750. Here, you're depreciating it by 11,000 hours. And ideally, when you think about it, when you're using 40,000 hours and you think it's going to last you 5 years, like I said, we should only be having it on for around 8,000 hours a year. We're using 11,000, which is a little bit more, which is why it's a little bit more depreciation. And again, we go in here, units of output method. I love a little chart like this. It shows us the year, the purchase price, the annual depreciation accumulated, and how much is left. And what you would do is that you would fill this out as every year went on, because you cannot assume how many viewing hours you would use in year 2, 3, 4, and 5, whereas in straight line method, you would be able to. Okay, so that is in a nutshell what we're looking to do here. Break-even analysis as well as depreciation methods. Depreciation should be a slam dunk for you. It's a fairly simple concept, and as long as you have the numbers and the formulas, I don't imagine you having a difficult time with this. Let me look. So when we talk about break-even, basically what we're going to be doing is we're going to be going through a break-even scenario. All of these have the answers in them. A break-even scenario is of how much you need to spend on fixed assets, how you can reduce your variable costs, and how many items or units you must sell. And in a perfect example, we'll be talking about a pizza store. So how many pizzas must they sell in order to break even? And there's a lot of different items as well, such as soft drinks, wine, coffee, candy. This will all be posted here shortly as of Monday. Like I said before, there'll be no live class this week. And I know this is a lot of material, but next week we'll go through all the material and make sure that you are understanding of it all. Thank you very much for watching, and we will talk to you soon. If I can figure out how to stop this.